The US stock market is in a tumble over the last couple of trading sessions, and heading into Friday's trading session, the stock market is now pricing in the potential of a recession that looks to have been signaled by Target's latest quarterly results. That's what we're gonna cover in this video, so smash that like button and subscribe if you're new. You're watching More Money, let's get it. What's up, guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into this. So you can see here that the US stocks actually finished today, Thursday, much lower in a turbulent trading session. And the reason for that is because you can see what happened yesterday, where the Dow dropped more than 1,100 points because the market is now starting to price in a recession. And you can see from the blue line that's Target's share price. It actually declined 35 or so percent, much more than the S&P 500 index as a whole. But you can also see in there is Walmart, and you can see that's a straight line down as well. And the reason why we know that both of these retailers' share prices have declined just on a straight line down is because they're both feeling the impacts of inflation, and they're unable to pass it on to their consumers. So here's a surprise for a lot of investors who thought that Target and Walmart were inflationary shields. The only thing that I would say, and what I've explained to the Patreon investors who ask about this, is that some of their products are less elastic. In other words, people are more likely willing to pay the higher prices, but not all of their products are elastic. So for example, Walmart talked about how some of their other types of products, and I'm guessing like sporting goods and seasonal stuff, may not necessarily have been purchased as much as, for example, people just focusing more on their grocery basket. So that's what you got to think about when you think about these retailers. They sell many products, and not all of them are inflation hedges. Like, look, at the end of the day, if I'm struggling to just put food on the table, I'm likely not going to visit the toy aisle, especially if I have my kids at Walmart with me at the same time. And so you can see here, as reported by the Wall Street Journal, major retailers said their profits were hurt by rising costs, sluggish sales, and supply chain disruptions. And all that really means is that's just corporate speak for the fact that they can't pass on those rising costs to the consumers, otherwise they would have. And this at the bottom here, you can see, is the results are prompting Wall Street to wrestle anew with the idea that the global economy could be headed for a recession, which at the end of the day, it's not something that we weren't afraid of. It's just everybody just didn't know if it was going to happen or not. And to be honest, it's still a bit of a debate, so we'll see what happens going forward. But you can see here that Target's share price actually declined 35% on the day, as people are sort of figuring out that they're going to struggle for the rest of the year. Now, on a trailing PE ratio, you can see here that they're trading at 11.5 times earnings. The reason why their PE ratio is so low is, of course, that E of the PE ratio is expected to decline in 2022, and thus their forward PE ratio is likely somewhere around 15 to 20 times. And in Barron's, they went on to say that it was mostly, if not all, due to earnings from Target that caused the major market sell-off. The big box retailer not only missed earnings expectations, but also said that margins would continue getting squeezed due to inflation. From there, it was easy to extrapolate Target's problems to the broader market. So the fears of a recession are definitely on the rise. And that's where this channel becomes very important, because I've always focused on rule number one, which is don't lose the money. And so the only way you can focus on rule number one is you use sort of like a Charlie Munger-ism, where you sort of look at the problem backwards. You don't think about how much money you can make. You think about what is the potential for me to lose money with this investment. So the Patreons almost get a little bit annoyed from me, because I always say, what is the downside risk here, and how can I sort of address the downside risk here? So they've noticed that in this environment, as I've been making purchases, I've only been focusing on decently good quality companies that are trading at 50% or less than in their intrinsic value. And in the comments to some of these other videos that I've been putting out, some of the people have been saying, hey, you should be nibbling a little bit, blah, blah, blah. It's not really how I want to invest. I want that thing to get under 50%, and if not more. So even if the thing is trading at 50% of its intrinsic value, generally what I'll do is I'll sell a cash secured put on it if the yield is high enough to get it way under that intrinsic value. Because at the end of the day, I'm greedy when it comes to buying these names. I have my whole career to continue buying up these securities, so I can really pick my spots. Now, Does it always work out for me? No, but up until now, it's worked out pretty good. But I do want to show you guys something. This is something that the Patreons have access to. This is our companies that we're following list, or at least this is a snapshot of it. But what I want to show to you is that on the right here, we focus on metrics that are not just what is the share price as a percentage of its intrinsic value. We absolutely do focus on that metric, and you can see that in the middle of this picture here. But on the right, you can see that we also focus on additional risks, which are, does the company have debt, which is probably not a good thing in a rising interest rate environment. Is the company inflationary resistant? That doesn't mean are they downturn resistant. It means are they able to pass marginal price increases on to their customers? And then what is the size of their economic moat? And the greater the economic moat, the more likely they are to weather downturns. And so the first name that you can see, Alibaba, they have no debt, which is great. Their platform is inflationary resistant. That doesn't necessarily mean that it's not downturn resistant. If people are selling fewer products on their platform, obviously they're going to make less revenue. And what is the size of their economic moat? Well, Alibaba has been struggling this year with greater online competition. So because they've been struggling with greater online competition, you can't say that they have a strong moat. So we are actually one of the few people who actually believe that Alibaba has a medium-sized economic moat. There's a lot of value investors on YouTube that believe that Alibaba has a very strong economic moat, and we respectfully disagree, or at least I respectfully disagree. The second name that I want to talk about here on our list is Zillow. This is a company that I have covered on the channel before. You can see that their price to intrinsic value is around that 50% area, and they have no debt. Their platform is inflationary resistant, and their economic moat is very strong. So this is one of those perfect type companies, and so I have them highlighted green because it's a very special name. And I only really have maybe 6 or 7 companies out of all of the companies that we're following that gets that green highlight because they meet all of those 3 criteria. But the reason why Zillow's shares have been trading down, because there's fears about a really strong downturn in the housing market, and I totally understand that. And so I've been very selective in how I've been picking up Zillow. I've actually been selling cash secured puts on it as the shares have been under 50% of their intrinsic value at a rate of over 20%. And so what I've actually been doing is heads I win because I get that 20% and I don't get exercised on that option. And tails I also win because if I get exercised on that option, my net purchase price is significantly lower than even 50% of the intrinsic value of what it's trading at currently. So no matter what, I win. And this is a company that I do want to hold over the long term. So we'll weather this recession. And I do believe that Zillow will continue to outcompete its competitors in the future. They have a 60% market share. And I think that thing only grows over time. The third name that I did want to talk about is Best Buy. Now, here's a retailer similar to Target and Walmart, but in a different space, right? We got electronics here. So they're trading at close to 50% of what I think their intrinsic value is at $75, and their intrinsic value is somewhere around $130. So in terms of debt, they have no debt, which is really good. Are they inflationary resistant? Absolutely not. And the reason why is because even Best Buy has said on their Q4 conference call that they expect more promotionality in 2022 because they're just not going to be able to push that inventory without sales. And why are they expecting that more promotionality? Because there's less money in the system. There's less buyers out there looking for Best Buy products. But could this be an interesting time to purchase these shares? I think so. And when it comes to their economic moat, I say that they have about a medium-sized economic moat. Look, at the end of the day, they're competing against all these online retailers like Amazon. The difference with Best Buy, when it comes to Best Buy versus Amazon, is I actually think Best Buy is now better placed than Amazon, because if I go on Best Buy's website and buy a product, within a half an hour, I get an email saying that product is ready for you to pick up. So I can actually just drive down to the local Best Buy, which is generally for around 90% of Americans within like a 5 or 10 minute drive from their house. And you can drive right into the parking lot and somebody will walk out and deliver the product to your car. So that's a really seamless experience. I thought they were phenomenal the way that they did it during the lockdown. I thought that they were the best retailers that did it. I think Walmart was close, but Best Buy was much better. And it's something that Amazon can't compete against. Amazon can do their 1-day delivery, but I'm still waiting longer than that half an hour pickup that I can do with Best Buy. Now, if Best Buy ever teamed up with a DoorDash or Uber Eats to deliver the product to my house within 30 minutes, game over, and I really hope they do that. Now with Alphabet, you can see that it continues to come down. A lot of people didn't think Alphabet's shares would continue to come down. They were telling me to nibble on it as it was trading around 70% of its intrinsic value, but I truly felt that it was going to come down, and now it is. And even if it didn't come down, I missed out on it, no problem. But Alphabet's another one of those where it's green across the board. So you see they have no debt, they're inflationary resistant, and they have an extremely strong economic moat. Google search owns like 92% of the market. But the one thing that I do want to point out, and you guys should pay attention to, is that there's legislation being written against Alphabet right now that could potentially hurt their revenue. So something to really pay attention to. It's a bipartisan bill, and I haven't really quantified what the impact of that will be. We'll see what their CEO says on the recent conference call about this particular bill. And the last name, Meta, you can see that it's actually trading under $200 per share. This is another one where I said I want to buy it at closer to $150 per share. People said that it's highly unlikely that it'll get there. I think it does get there, possibly, but even if it doesn't get there, it's one of those things where it doesn't matter. I don't mind missing out on the opportunity, but if the opportunity does present itself, happy to buy. But you can see with Meta, they have no debt, they're inflationary resistant, or at least their platform is inflationary resistant, but I believe that they have a medium-sized economic moat. And the reason why I believe that they have a medium-sized economic moat is because even Facebook has now come out and said, hey, we're experiencing competition from TikTok. So we'll see how this plays out. And the other obviously elephant in the room is how do they create the whole metaverse thing. So we'll see how that plays out. So that's an example of the discussion that we have on 5 names that are on our tracker. And there's maybe around 100 names on our trackers that we talk about every month on our monthly calls. But if you just want access to the tracker, and what the tracker does is you can click into each one of those companies and it takes you to a full model of those particular companies. You can access that at the $5 per month Patreon tier. And hey, if you're not satisfied within the first month, you get a full money back guarantee, because I'm absolutely certain that you're going to find more value from it than what you feel the money is that you're paying into it. And that's really been demonstrated by the fact that we have a greater than 100% retention rate, because more people upgrade than cancel. So I highly encourage you to join us. I think it's a great team and a great learning environment. Now, the other thing that I noticed is that US politicians just passed legislation that allows them to cap gasoline prices, which screams echoes of gas shortages in the 70s. Now, I covered that in a separate video, which you can get to right here.